Howdy folks, it's Dr. Jeff Camarda again, and happy October greetings. I've got some important things to share with you, and the first is my personal launch of a new Wealth Ed YouTube channel called The Wealth Doctor. I plan to generate lots more webinar classes besides the retirement one that we just launched, so please make sure you subscribe and pass the link on to friends and family to make sure you don't miss the opportunity to watch all those that interest you. I plan to cover trusts, tax tips, and tons more in the months ahead, and I think that you will love it. So please make sure you subscribe. Another exciting thing is our new ongoing Wealth Plan 360 system. Over the course of nearly the past year, Kim and I, with the help of Joyce and the executive team, have been hard working at my vision of a much more advanced wealth care system to bring that to you. Now, we believe this will reformulate and significantly improve the advisory delivery to you, our cherished clients. In addition to the details, in addition to details that you get on quarterly calls with investment updates and so forth that you've been used to over the past, my goodness, 20 years, and tweaks to the investment policy, portfolio plan, and the other stuff that we've been covering for a long time. Wealth Plan 360 is designed to deliver expanded financial advice on estate, tax, insurance, charitable giving, education, and lots more, custom tuned to your needs and priorities. It'll include things like making sure all your beneficiaries on insurance, IRAs, and benefits and so on are coordinated. We can check and help you tune up your auto and homeowners insurance, work with your tax preparer to optimize Roth conversions, and lots more that I won't gush about now. We'll game plan this with you each year when we do your annual update, check on your financial status and data, and work on a chunk per quarter so you can work it into your life and not get overwhelmed. Now, we can cover the items during the quarterly calls or another time, depending on the complexity and your availability. The system really represents a quantum leap, in my view, in our deliverables, and Kim's done a great job building the task tracking software to stay on track and help make sure that to-dos are done to schedule and don't become drop balls. Executing my vision and algorithms is no small feat, but my perfect partner is up to it, and much more. Now, because all of this represents a lot more work on our part, and we're very happy to do this, we're shifting to a team and specialization approach to handle all the various tasks and disciplines. You can expect to hear from me lots more than you used to, as well as other CFP grade planners as we expand the advisory bench to get the work done. You'll meet and be working with some new folks, and I, for one, am very happy you'll have a dedicated team instead of just one primary contact. Backups are important and help us get the work done faster and better. So I'm really excited. It's been a lot of work by the growing great team, and it's rolling out now. And I think you'll find it really valuable and worthwhile, so I hope you'll take full advantage of it. The last thing I want to talk a little bit more about before we get into the retirement webinar that we just launched, you'll have a link to, is about what's going on in the markets now. And this is before we talk about what's going on in the Middle East. You probably know it can sense from me that I've been concerned about market overvaluation and the potential for drops for some time. A lot was covered in my book, which I wrote, gosh, seems like forever ago in 2020. But a lot of the themes in that book have not gone away and I think are coming to pass now, particularly issues with a mounting federal debt and other big stressors. So what's going on in the market now, I think you'll know, is really due to two factors of late in my view. First of all, I think that stocks have been overvalued for a while, particularly tech stocks, and it's finally dawning on a lot of investors and professional investors and otherwise. Stock prices are soft and maybe getting much softer. Interest rates have been rising for many reasons besides the Fed and look to be going up for a while. The federal debt is getting so high and supercharged by the higher interest costs on carrying the debt as rates rise, and many besides me fear the markets won't be able to absorb all the government bonds needed to be issued to carry the skyrocketing debt loan that they're really cranking them out more than investors seem to want to absorb. Remember, rates go up, bonds go down, and they've been falling 3 years now, bond prices, with maybe no end in sight. And I'm sure you've seen this in the popular financial news, but short-term interest rates have been up for a while now, long-term rates, which the Feds have not been specifically targeting, have been going up on their own for a variety of reasons that I'm not going to get too much into now. But the short of it is, because bonds are going up, the cost of doing business is higher, investors have other alternatives, inflation still remains a dangerous issue, so bonds are really plunging for a couple of years now, and I think this will continue. I think it's the third year in a row. At the same time, as a weak stock market is increasing the risk of continued weakness. So I think it's going to be a rocky time. As you know, one of our primary portfolio management goals is to protect value in declining markets, and I think many of you are well positioned for that now based on the portfolio plans that we built for you, and I'm certainly in that camp with my own family's money. It's been a crazy couple of years, but please remember, we're playing the long game here at Camarda. Quarterly bounces up and down really don't matter much in the rearview mirror, but we're very, very focused not just on growing, but protecting your wealth. Many of my book's predictions may have seemed early, but they're no less concerning for that. Since things started hitting the fan in 2020, we've worked on a long-term plan designed to see you safely through. And while the seas have been, and I think will continue to be, uncomfortably rough, I think our course is sound and our hands steady. Thanks for your confidence in staying the course with us. For now, that's it for Jeff Camarda. Hope you enjoy the retirement webinar.
So I'd like to switch it again a bit to another topic. You see the slide here: avoid common traps to protect retirement wealth. And this is probably an hour and a half class, something like that I prepared. And you should have a video to watch the entire class attached to the email that has this video of me talking right now. But there's a couple of points that I want to make. I'm not going to go through the whole thing now. The first is, it's not news to any of you, but there's tremendous pressure on the federal government. The negative cash flow is probably the best way to describe it. And it's not just one thing. Social Security has been going bust since I was a kid. I mean, I remember learning about this as an undergraduate. The blue line there is the bottom, axis is time. The blue line there are assets that are earmarked to pay Social Security benefits. The red line is how much is going out to pay retirees. You can see it really hits the fan about 2025. Social Security is rapidly becoming insolvent and is going to be in need of some sort of a reformation, which I don't think is politically viable, or a bailout. Same thing is happening, similar things with Medicare, just not enough money to pay the benefits. I'm just going to flip through this. You can see my takes on all these slides if you watch the class. And a lot of the pressure, on bonds and so forth is just the government's just spending like mad, and deficits are way out of control. This is a piece from Barron's in June of this year that the total federal debt held by the public is projected to hit 107% of the entire business and economic output of the U.S. in 2029. That's an entire GDP, topped by 7% in 2029. This is another look at how bad things are getting. Debt has nearly quadrupled from 1995 to the current year, gone up 4 times as a percentage of gross domestic product. This is an even scarier graph, and if you look, let's see if my mouse will record here. But here's the old record set right about 100% of GDP after paying for World War II, which was not an inexpensive venture. And if you look at what's happened since then, it's came down, got really manageable in the 90s, popped a little bit here. But since 2008 has been going up like a rocket ship. Now we're actually past, by some measures, the World War II peak, and it's projected to double from here. And this is assuming interest rates stay low, which they haven't. I mean, these forecasts are based on rates that were current when this projection was made by, I think, the Government Accounting Office. But it's getting pretty scary. Interest cost increase are going to make it worse and worse with rates going up. And there's not as much appetite for government debt as there used to be for a variety of reasons. So we have more supply, less demand. Price has to come down. Lower price means higher interest rates. And net interest as a percent of revenue is really expected to go up quite a bit. Annual interest on the federal debt is in the Wall Street Journal. The scary math behind the world's safest assets shows what will happen to the actual cost if rates go up just a little bit. The blue line here, which is, I think, ostrich head in the sand, is the Congressional Budget Office's forecast. But I mean, that ship has sailed. It's not a zero interest world anymore. They were talking in today's Wall Street Journal about mortgage rates justifiably in the 8% range. I can't remember the last time we saw that. It's been a really, really long time. So not, to get too excited about the slides. But please watch the video, because I think it's not just this, but also what's happening with inflation and the markets and smart, Roth conversion strategies, and a lot of really powerful information. I think you'll find valuable. And I've really made the commitment to go ahead and try as much as my staff can help me get the stuff done, because there's a lot of pieces. And this is beautiful. Meg's done some fabulous work on these slides. But it's anyway, I'm committed to generating a lot of this video educational webinar type content. So please watch. The green circles, by the way, that's where Meg actually put my face. She filmed this with a computer and a couple of cameras and so forth. So it really is very highly professional quality, but I'm not so good with it, as you can tell. All right, so I think that is pretty much it. Look forward to, hopefully you found this worthwhile. And as things, look, as the news dictates, I'll be producing more of these just to let you know what's going on. But the short of it is, this has not been unexpected by me. Sometimes it takes a while. There's an old expression that the market can stay irrational longer than you can stay solvent. And the essence of that is, some stuff is really out of whack. It shouldn't be there, but it just stays there because people don't act rationally. But eventually things tend to balance out. And we have been expecting this, and a lot of our portfolios, based on your investment preferences, have been more conservatively tuned and tactically tuned to bear, to weather these kind of conditions better, and to get you through with more value on the other side. And things eventually turn, and when they do, we hope to be ready to plow back in, but not yet. I think it's going the other way for a little while. All right, so that, let's see how I can turn off the recording. That's it, folks. Thank you so much for watching this blowy October evening. Hope to talk to you soon. And really excited about this new wealth plan regimen. So please take advantage of it as you chat with your personal wealth advisor and the rest of the team that's available to make sure that you get the maximum value you can from us. Thank you so much for watching. Bye-bye.